Good morning, my name is Musab Hassan Isaac, and I'll be explaining question 1A and B. So for question 1, we were asked to prepare an absorption costing income statement with one column showing 30,000 units and then one showing for 35,000 units. So 35,000 units were produced initially and 30,000 were sold. So then that left 5,000 units remaining as ending inventory, and each unit is valued at 19 ringgit, meaning the ending inventory total sum was around 95,000 ringgit. So under absorption costing, fixed manufacturing, those were all included in the inventory, and part of the cost is deferred to future periods, and this results in higher operating income. And this is the table for question 1A that we were asked. It's also in the report, but I just copied and pasted. So this is the sales, where produced 35,000 units. They both have the same value, 750,000 ringgit. And the only thing that differs for the cost of goods sold for the COGS is the manufacturing cost per unit. So when it's 30,000 units, it's actually 21 ringgit, and when it's 35,000 units, it ends up being 19 ringgit. And for the total cost of goods sold, for 30,000 units, it's actually higher, 630,000 ringgit, while 35,000 units is actually 570,000 ringgit. So the gross profit is 120,000 ringgit for 30,000 units and 180,000 for 35,000 units, and selling and administration cost is the same, 25,000 ringgit, and the operating income is obviously higher, 155,000 for 35,000 units and 95,000 for the 30,000 units. And question B is asking, why is income different for two production levels where sales are both 30,000 units anyway? Here's a quick little summary for that question. The income difference is caused by how fixed manufacturing overhead is treated under absorption costs. So when 30,000 units are produced and sold, all fixed manufacturing overhead is expensed in the current period, resulting in lower operating expense or lower operating income. So when 35,000 units are produced but only 30,000 are sold, some fixed manufacturing overhead is included in the ending inventory, which is 5,000 units. And these fixed costs are deferred to future periods, reducing the current cost of goods. And as a result, operating income is higher when production exceeds sales. Thank you.
Hello, I'm Tang Jun and I will be presenting the solution for question 2A, which asks us to determine the total cost per section. To find the total cost, we need to calculate two components, the variable cost and fixed cost. First, let's look at the variable cost. These are the costs incurred for every single section based on the data we have. Digital materials at 50 ringgit, direct labor at 350 ringgit, variable overhead at 60 ringgit, and variable expenses at 45 ringgit. When we sum this up, the total variable cost is 505 ringgit per section. Next, we calculate the fixed cost. We have a fixed overhead of 720,000 ringgit and fixed selling expense of 600,000 ringgit. Adding this together gives us a total fixed cost of 1,320,000 ringgit for the year. Since the company plans to conduct 1,200 sessions, we divide this total by 1,200. This gives us an allocated fixed cost of ringgit 1,100 per section. Finally, to get the total cost per section, we simply add the variable and fixed components together. 505 ringgit plus 1,100 ringgit give us a final total cost of ringgit 1,605 ring per section. That concludes part A. Thank you.
My name is Goijun. Now I'm gonna continue about my part, question 2B. Determine the desired ROI per season. Luna Creative Workshop aims to achieve at 80% return on initial investment of RM 1,800,000. To calculate the annual return on investment, we multiply the total investment by the ROI percentage. This gives us an annual ROI of RM 324,000. Next, to determine the return per season, we divided the annual ROI by the total number of seasons, which is 1,200. As a result, the ROI per season is RM217.
Hello, madam. My name is Qin Zheng. In this part, I will explain how I get the markup percentage. First, from our previous calculation in questions 2A, we know that the total cost per season is RM 1,605. This includes both our variable and fixed cost per season. Next, we need to achieve our target profit. As shown in questions 2B, our desired ROI per season is RM 270. To calculate the markup percentage, I divide the desired ROI per season by the total cost per season and then multiply by 100%. RM 270 divided by RM 1,605 gives 16.82%. So the markup percentage on the total cost per season is 16.82%. And that's all of my part. Thank you, madam.
Thank you. And hi guys, and my name is Elijah Bao, and my part is question 2D actually is calculate the target price per seasons. So the target price per seasons is the formula is total unit cost plus total unit cost multiply markup percentage. So right, it is the target price per season and RM 1,605 plus the RM 1,605 multiply with the 0.168, so we get like 217. So plus together with the 1,605 plus the 2017, the answer is RM 1,875. Yeah, that's all my part.
Hi guys, I'm Mithun Raghav and today I'm going to present my last part, question 2E. Pricing is the process of setting how much price business charges on its products and is therefore a fundamental part of any business's and vitality contributes to its success or failure. A business has to make consideration about the price its competitor charge, the price it provides to its customers, and it targets profit prices for its iPhone, and this is attributed to the level of innovation and quality present, which leads to maximum profit accrued to the brand. Thank you.